Hello, it's Jeffrey Christian of CPM Group. It's noon on Friday, the 17th of November here in New York. I want to talk about realistic long-term price metals expectations. I apologize for wearing my reading glasses, but I have a lot of notes that I want to use and cover, so I need my glasses on to see them. I will be speaking ex-temp from an outline. This is the price of gold since 1968, since the gold price was free to float and went from $35 on upward. We are testing 2000 right now, or testing 1996 on the COMEX. Our prices that we tend to quote in these videos, by the way, are COMEX nearby active futures contracts. They differ from the spot price that you'll see in London. They'll differ from the spot prices that various dealers quote that are their own spot prices. And they'll differ from the prices you'll see on Kitco and other places. But they're COMEX nearby active futures contract, not the COMEX spot price, but that. But this is the gold price. We're testing 1996 today in gold. But I want to talk about our long-term expectations and what's a realistic expectation. Before I do that, I'll maybe prick some feathers. I have a saying that I often use to myself: often amazed but never surprised. And it really applies in just about every aspect of modern society. One of the things that you'll find is people speaking about that which they do not know. Now, it clearly happens in precious metals, and everybody has an opinion, and they're entitled to it. They're not entitled to having their own set of facts that differ from the realistic historical facts, but that's another issue. But one of the things that amazes me, and I've seen this my entire life, is people willing to talk about CPM Group and me without even knowing anything about us. You know, there was a guy who was criticizing me a few weeks ago in a YouTube. I had never even heard of him, but somebody said, "Hey, this guy on some video is criticizing you." He didn't even know the name of the company, what CPM stood for, which is Christian Podleska and Van Musschenbroek, because that was the three principal analysts when we created the company in 1986. You see a lot of people criticize us for about a lot of things, and we're used to it. And I don't mind if somebody criticizes me from a position of intelligence and knowledge, but a lot of people don't have any clue what they're talking about. And one of the things that you hear is, CPM Group or Jeff Christian has turned bullish. We've actually been bullish on gold for most of the time since November 2000. We did turn bearish in January of 2012, and then we issued a buy recommendation in 2013. But for most of the last 24 years, we have been telling people, longer-term investors, you should be buying gold. You should have an increased portion of money in your gold portfolio, in gold in your portfolio. And the same is true pretty much for silver. I think we issued a buy recommendation there in 2005 or so. But these people who don't know anything about CPM Group or me will say, Jeff Christian's turning bullish. No. Now, I will talk about our longer-term outlooks for gold, silver, platinum, palladium as this video proceeds. And one of the things that you'll learn is that we are still bullish on gold and silver, less so on platinum and palladium now. But we're less bullish in terms of how high we think the prices could go than we used to be. That's just background. CPM Group projects the nominal and real prices on an annual average basis going out at least 10 years across commodities, everything from oil and natural gas to currencies, major currencies, which are not commodities, but we've been involved with them since the 70s. Precious metals, base metals, specialty metals, agricultural commodities too. We project annual average prices, real and nominal, We have a projection for our expectations for the U.S. CPI going out. Actually, our CPI projections go out to 2050 because some of our other metals, we don't project out 10 years. We project out 15 years or even to 2050. Platinum and palladium and rhodium, we have been projecting to 2050 since 2017 because the energy transition and its effect on PGM use in autos is going to be a multi-decade transition. It's not going to be over the next 10 years. And so we have longer term projections for that, those metals, and also energy metals that are being used or may be used in smaller volumes or increased volumes in batteries and electric vehicles over the next 25 years. So we project those annual prices on a series of things, and I've talked about this in past videos, but a couple of years ago. We project them on a realistic view of economic and political developments and expectations. We don't go around I've known people since the 1970s who were talking about the collapse of the dollar, the collapse of the treasury, the collapse of Western civilization. And those are unrealistic expectations. They haven't happened, and they're probably not going to happen. There are problems. Those problems will cause recessions. Those problems will cause all sorts of other crises. We might actually get to a point as a society and as a world where we reduce some of those problems. I'm not sure that that's going to happen in the next 10 years, unfortunately, but I think it's there. We look at a realistic expectations, and we run several scenarios. We had one client who wanted 30 scenarios. In the past, we used to run 5 or 7 scenarios. Now we will run 3 scenarios. Mean scenario, most likely, and then a high and a low scenario, depending on the environment. But our price projections are a marriage of these long-term, realistic expectations of the economic and political developments that the world will experience, and a realistic assessment of the fundamentals of each individual market. You have to understand what's realistic in terms of supply and demand, reserves and resources, inventories above ground, the price elasticities of fabrication demand, investor behavior during periods of rising and falling prices. All of these fundamentals are very important, and they're very distinct and unique from metal to metal. I was at a industry dinner here in New York this week. It was very interesting because one guy said to the speaker who was talking about silver, at what price might some of these investors who hold a couple billion ounces of silver sell? And they started talking about, well, at $50, you saw a lot of metals sold in 2011. But that wasn't actually the case. The average price of silver in 2011 was $35.29 on average. $50 was never quite reached. It was like $49.98, and that was for about 2 minutes on the last trading day of April 2011. The average price is what counts, $35. We saw a lot of precious metals sold, both in jewelry, scrap basis, people saying, hey, at $35, I'm going to sell my jewelry, silver content, or my silverware that I have, or other statuary that I have that's sterling silver. It was $35, not $50. You have to understand these nuances. Similarly, if you're thinking that silver, for example, is in a deficit, and you are thinking or even writing in your promotional reports that, over the last 2 years, there's been these deficits that have totaled 500 million ounces or whatever unrealistic number you have, and that's drawn down all of the silver that was built up in the past. So those inventories are largely gone. You've got a fundamental error there. Specifically, if you get those high numbers for deficits by including investment demand in with fabrication. That's a no-no economically, but promoters do it, and they've been doing it since the mid-90s in gold and silver because they want it to look bullish. We're not looking at 100 million ounce surplus. The real surplus this year in silver is about 100 million ounces, a little bit less. We're looking at a 200 or 300 or 330 million ounce deficit. And we get to that deficit by plugging in inflated numbers for investment demand. But those inflated numbers on investment demand are 600 million ounces of silver that was added to above ground inventories by investors. So those deficits didn't deplete above ground inventories. They added 600 million ounces to it if they were right. Fortunately for the silver market, those numbers are wrong, and it was probably less than half of that. But that's beside the point. You've got to know what the fundamentals are, and you have to have realistic expectations. We've wasted a lot of time in these videos talking about what's unrealistic and how much metal is really in underground reserves and resources, stuff that can be mined and will be mined at higher prices. And we've also talked about the fact that, yes, there are any number of investors who, when they see $35 or $30 or $33 or $40 or $50, will sell their silver. So you have to have realistic understanding and expectations of the economic and political macro environment that affects investment demand and everything else, mine production, secondary recovery, fabrication demand. And you also have to have realistic expectations and an understanding of the fundamentals of each market. And once you do that, then you can have a realistic view of the price of that commodity. So, first off, let's talk about gold. CPM Group expects record gold prices over the next 2 years. That said, we have had record annual average gold prices for the last 4 years. 2020 was a record price. 2021 was a record price. 2022 was a record price. 2023 is going to be a record price. The previous record in gold was $1,670 in 2012, $1,670 in 2012. That was surpassed by the annual average in 2020. And then in each of the subsequent 3 years, we've seen higher annual averages. Our expectation is that you will see even higher annual average record prices for gold in 2024 and in 2025. We have the price peaking in 2025. I won't tell you what our annual average price is. That's the special stuff that we have that we sell to investors and mining companies and governments and fabricators and everybody else who have interest in knowing realistic expectations of the prices. But I will tell you that that's 22% lower. Our peak 2025 projected annual average gold price is 22% lower than it was 2 years ago. We're still projecting record prices, but we're actually less bullish, if you will, in how high the gold price will be on an annual average basis. It's not $30,000, I'll tell you that. It's not even $3,000. But it's 20% lower than it was 2 years ago. Why is that? Because the economic and political environment has changed. Our expectations of hostile economic, financial market, and political developments actually has reduced over the last 2 years. Politically, I think we're probably more pessimistic than we were, although there are some things on a global basis that are changing, I think, for the better, but it's too early to really be sure. But our economic and financial market expectations are less pessimistic than they were 2 years ago. So we're still looking for record prices, And we're looking at realistic expectations of what those record prices could be. And those expectations have actually come down. Here's the silver price. And again, yeah, you could talk about $50 because we almost got to $50 for about 2 minutes in 1980, January 1980. And we almost got to $50 for about 5 minutes in April of 2011. Yeah, and then it came back down. So our expectation is that we will see record prices. We have record prices for silver peaking in 2025. 2 years ago, we thought that the price would hang up higher, and we were looking at a record price in 2026. And that record price that we were expecting in 2026 2 years ago was about 25% higher on an annual average basis than our silver price expectation for a non-record price. It will be close to the record annual average, which was $35.29 in 2011. Not 50, 35.29 in 2011 was the annual average price on a nominal basis. On a nominal basis, we expect the price to get close to that, but not quite there. So we're now looking for record annual average price in silver. And we're looking for a price that is significantly lower than we thought we might achieve 2 years ago. Platinum, we're actually more bearish on platinum and palladium now than we were 2 years ago. Our expectations are that the price of platinum may not peak until 2033. We actually have the price declining from the annual average in 2023 this year, going forward for several years before the price starts to rise again. And yeah, we're about 35%, 37% less bullish on where that peak annual average price will be in terms of level than we were in the past. And for palladium, surprisingly, we're not. I would have thought that we were more bearish on palladium. You can see here how the price spiked up and it reached a record of $2,394 in 2021 on an annual average basis. It's come and it got, close to $3,000 on a monthly average basis. These are monthly prices. Our expectation is that the price will continue to decline and then start to rise, and it will probably reach its next peak around 2030. So those are our realistic expectations for where precious metals prices can go over the next decade, and they're predicated upon a rational, sober, fact-based, reality-based projections of global and domestic and various national and regional economies, the political world. We're looking at a hostile political world that's up for change and redefinition. We're not looking at World War III, per se. It depends on how you define World War III. And rational, reasonable, fact-based, realistic expectations of the supply and demand and investment demand and inventory levels of these four metals. Based on those realities, these are realistic expectations for prices. We have produced a couple market alerts recently that have a long-term perspective. One was CPM Group's long-term economic outlook. We released that in early October. And then we did another one called Deficits, Debt, and Gold, which we released in late October. And both of those contained a lot of information about that long-term, what are realistic expectations for long-term economic conditions over the next 10 years. Those went out to our paying clients. You can become a paying client by writing to info@cpmgroup.com and say, what can I buy from you? I need research, I need advice, I need consulting services. Or you can go to www.cpmgroup.com and you can read about our research and consulting services and buy into, you can join the club. You can be part of the CPM Club and be getting the kinds of information that our clients receive on an ongoing basis from CPM Group that helps them have a good view and of what's a reasonable expectation for the future, including those alternative scenarios. For our clients, we will be doing another open forum on December 6th, a couple of weeks from now. If you're a client, you can plug in and you can ask us questions. If you're not a client, you can go to cpmgroup.com or send us an email at info@cpmgroup.com and say, I want to be a client, let's talk. That's all I have for now. Have a good weekend. Take care of yourself and those around you. See if you can do something good for the world, and we'll talk to you next week.